Welcome to Wealth Matters Podcast. I have with me David Chan today. David, how are you?
I'm doing well. Pesh, how are you?
Good, thank you. So, David has over 5 years of experience in finance and technology across agricultural business. Prior to joining FarmTogether, David was a senior private equity associate at AMERRA Capital Management, an asset manager that specializes in agriculture investments. So, welcome, David.
Thanks. Good to be here.
Absolutely. So today, of course, we want to talk about agriculture businesses dear to my heart. I have personally invested in three different agriculture investments, all of them out of state. Being a vegan, I feel like agriculture is, of course, very important to our environment, our society, and and as we all know, that it's here to stay. Right. So, of course, we'll be digging deeper, and I have interviewed before, the farms or the people who I work with for managing my cacao farms to orange tree farms, etc., as well as the coffee farms. So we'll discuss more about where you guys invest and why you invest locally. And I wanted to know more about it as well because living in California, I know lot of the fruits and nuts grow here locally. But before we get started, let's talk about you. Tell us something interesting about yourself.
Sure. So to start, I think most folks would be surprised when they meet me or hear my name to find out that I actually do not have any Asian heritage.
Yeah, I'm
Um,
like, okay, you don't look Asian.
there's a good Seinfeld episode that makes a joke about this. But yeah, I my parents are from Spain. I grew up
ah,
in New York, and I have no ties to Asia that I know of. But
so you don't know Jackie Chan.
I unfortunately do not. But anytime I'm on a call with someone who's taking down my name and I say my last name, it's always hard to hear like N versus M. So I usually say David Chan like Jackie Chan, and that
Of
always
course, yeah.
clarifies.
That makes it easier, right?
Yeah.
So let's talk about farmland. Why invest in farmland?
So farmland, in our view at FarmTogether, it is just one of the best asset classes that has yet to be untapped, and largely so because it's privatized. So in the U.S., 97 or to 98% of all farmland is privately held, meaning that individuals or small private companies own just about 98% of U.S. farmland. The balance of which, that 2%, would be comprised of institutions. Insurance companies, investment firms, university endowments, and the like. So this is a very fragmented and untapped space. We think the asset class is so interesting because it's a real asset. So you're investing in something tangible that exists. It serves a purpose. It's a durable good. Demand does not wane based on broader macroeconomic trends or the environment. It provides two return streams like real estate. So there's an income stream, either from rental income or from operating income if you choose to directly operate the farm. And then there's also appreciation. So the underlying asset will appreciate with value over time. And additionally, as a strong inflation hedge, farmland has tracked inflation very closely. And finally, I think it's just about the ultimate diversifier because it is so in so few investors' portfolios. It really doesn't have any relationship with broader asset classes like stocks or bonds or even real estate. And arguably, it's in the real estate family since it's a real asset. So we think for all of those reasons, it's an excellent asset class that should be in just about everyone's portfolio.
Got it. And as I said, I invested in acquiring small half an acre parcel in a large farm out of country, right? So, and I have understood that business side where, I'm actually owning the, parcel and the people are just managing the property, right? So more like turnkey. So how does FarmTogether compare to other ways someone can invest in farmland?
So FarmTogether makes it possible for retail investors to invest into farmland through our structuring. So each farm that we syndicate on our platform is a standalone LLC. And so when an investor decides that they want to participate in a given deal, they are investing into that specific LLC. They're typically sequential: FarmTogether 200 LLC, FarmTogether 300 LLC. An investor has so much more control and decision making over what areas of the country they want to invest in, whether that be California or Washington, what commodity groups, if they want to be in an almond property, if they want to be in a hazelnut property or a citrus property, whether they want to support a transitional property that may be transitioning from conventional farmland to certified organic. So there's a lot of decision making there. And then also in terms of suitability and matching risk preferences. In terms of the risk spectrum for farmland, the least risky type of opportunity would likely be a cash rent lease, often on a row crop property, where you're leasing the property to a tenant and collecting rental income, and you have almost no operating performance exposure at all. And returns are going to be a bit lower as a reflection of that lower risk. On the other end of the spectrum, in the permanent space, like almonds and hazelnuts, if you take an old orchard, purchase an old orchard, and your plan is to remove the old trees and plant new ones, that's going to be a higher yielding opportunity, but also there's going to be a bit more risk because you're going to have to wait a couple of years for the trees to develop.
Got it. So how does it compare to traditional investments like stocks and bonds? And this show is all about alternative investments, anything other than Wall Street, right? But I always end up comparing, be it real estate, even if a strategy in real estate, people want to know how does it compare to Wall Street, right? So what about farmland, or how you guys do the business? How does it compare?
Sure. I would say it's certainly less volatile than the stock market. So farmland is notably a very steady and consistent asset
So
class.
it's not exciting, right? But
That's exactly right.
I like boring.
It's just about as boring as they come. And that's another reason why we think maybe it hasn't really been,
Yes.
untapped. But look, I think 2020 has given us enough excitement. We like boring.
Oh,
right
yeah.
now, so.
Yeah. Corona, tornadoes, and of course, being in, Bay Area, wildfires.
Yes. Volatility tends to be very low in farmland compared to the stock market. The bond market right now has been struggling because of where rates are, and we view rates are going to be near zero in perpetuity. We have no reason to believe rates are going to increase. The Fed is telling us rates are going to stay here for the next 5 years at a minimum. Yeah. And so on a real basis, bonds, in our view, are not really a competitive asset class. When we look at alternatives or other real assets, if we look at real estate, we've seen, and happy to touch more on coronavirus later, but we've seen a lot of stress in real estate because of coronavirus, which is certainly understandable, which we have not seen in farmland. There have been some tremors and some impacts, but by and large, fundamentals are still the fundamentals that they were before. And we have not seen meaningful shifts in supply and demand as a result of COVID. When we look at an alternative like gold, we think gold is an interesting comparison, and one that is comparable in terms of, I think its ability to store value. It is an excellent asset class for capital preservation, and farmland has been as well. I think that the pitfall that gold has against farmland is that there's no income stream for gold.
Yeah, it's just I look at gold as a good hedge, and it's just when there is a currency risk, gold would be, or the precious metal would be the way to go. But yeah, there is no cash flow.
Right. Largely, across the board, we don't see much. We don't see much correlation between farmland performance against any of these major asset classes, and that's one of the reasons we love to include it in a diversified portfolio, because it just adds so much benefit from being the sort of standalone stalwart of an asset class that doesn't react to geopolitical news or macroeconomic news or the like.
Got it. So, and also I heavily invest in real estate because whenever we talk about alternative investments, real estate, is the huge part of it. So how does it compare, or how does it fit into the universe with other alternatives like traditional real estate, right? Buy and hold rental to commercial office space to, holding notes. Uh, do you recommend, do you look at your own portfolio and look at it that way, that you got to have certain percentage allocated to real estate, to gold, to farmland?
Yeah, I mean, here I would just say I'm speaking personally, and this certainly isn't a recommendation, but I think the way I look at it, I love real assets. For me, real assets are, a meaningful portion of my
Right.
own portfolio, and I think, you know, it, my view is that they're going to become an increasingly larger representation of most investors' portfolios, be it retail or institutional, because of this new paradigm that we're in of low interest rates and low yield. And so, when I think about within your real estate allocation bucket, how do you allocate? I would certainly never tell any investor you should only be in farmland. That wouldn't be prudent, or you should only be in gold. I do think that you should diversify across different real asset
Yes.
strategies, and have a portion in real estate. We actually believe that farmland is most comparable to multifamily in terms of in terms of the landscape and the fragmentation of the market and how privately held it is. So would certainly understand and encourage investors to have residential, to have some commercial representation in their portfolio, to have gold, to have some timber, and to have farmland. Across all of them, of course, we think farmland is the best. That's why we're here. But we think that they all are, serve an important purpose, which is ultimately portfolio diversification.
Got it. So what are the typical returns you see in this asset class?
In U.S. farmland, the typical returns we see, it varies quite a bit based on the underlying mechanics of the deal, of the opportunity. So if we're looking at row crops, earlier I mentioned that row crops and the cash rent lease model tends to be the lowest form of risk, and also the lowest yield. So if we look at that model where you, the investor, would receive cash rent from the tenant in the first quarter before planting even occurs. So there's no risk to you really on weather or even the tenant's skill for that given season in terms of operating. Of course, you want them to be a good steward. But operating risk is really negligible to your performance as an investor because your income stream is that rent. And so in those types of deals, we're seeing typically a net IRR of 7 to 8%, and a net cash yield of about 3%. Now, as we start to move further along the risk spectrum and start to introduce a bit more risk, if we look at permanent plantings like tree nuts, citrus, almonds, hazelnuts, tangos, for a turnkey orchard, of course, we're going to be paying more for a turnkey orchard, since those opportunities are producing high income streams, high cash yields year one. So you do compromise the IRR at the expense of that. So there we're probably seeing net IRRs of maybe 10%, 9 to 11% if we put it in a band, and cash yields of fairly strong cash yields of likely 9%. And then if we look at the more high yielding opportunities, which would be development properties, similar to real estate, if you're in a development opportunity in real estate, where you're planting trees or you have a young orchard, maybe it was only planted 2 or 3 years ago and you're still waiting 2 or 3 years for production. Those opportunities will likely have IRRs in the low to mid teens, anywhere from 11 or 12% to maybe 14%, and cash yields of around 10 or 11%. And then finally, there's sometimes opportunities in the specialty market, such as certified organic or transitioning to organic, where you can unlock even more value. And so for some of those opportunities, although rare, we can sometimes see returns, IRRs approaching upper teens. So it's a pretty broad spectrum. Like anything in finance, it's a function of risk and yield.
What about risk and overall portfolio positioning in the current market?
So we think in this market, we still think that this is a fairly safe asset class overall, even if you're in the higher yielding end of the spectrum in development, because of strong fundamentals. Again, fundamentals do not change. People have to eat. Doesn't matter what's happening in the world, that truth will not fade. So we still actively invest in permanent plantings today, and we think that there are actually a lot of interesting opportunities in permanent because of the coronavirus to find some attractive purchases. So it really hasn't shaped our investment strategy all that much. I think it's certainly for us a bigger 2020 event has truthfully been the wildfire event, which has not impacted any of our properties, but has certainly has served as an underlining event that climate risk and mitigation is critical in the work that we do. And we do underwrite for climate risk or opportunity. In some places, climate change is actually favorably changing the prospects of a given property. But we do underwrite for that risk. And the wildfires this year really put that into perspective, how important that aspect of our underwriting is.
So that's a good point you brought up about wildfire. And you said you underwrite for the risk. So do you have insurance against certain natural calamities, natural disasters, etc.?
It depends on the property and depends on where the property is geographically based. We do have insurance. We have base insurance on all properties. So general casualty and liability insurance on all properties. Where applicable, we do look for supplemental coverage. And it's actually an area that we're exploring with innovative insurance providers and underwriters where, they've never created a young tree product. So an insurance product to protect against death or, basically a tree death event for trees that have not hit maturity. So we're working with some providers to create that product, and we would be looking to secure that coverage for some of our younger development properties. We also are working with some providers in crafting fire insurance, supplemental fire insurance, something they haven't done simply because in the areas where farms are located, the event occurrence for wildfires has actually been close to zero, if not zero. And again, none of our properties were impacted by these wildfires. So we don't have any expectation that this will be a direct issue or threat to our properties in the future. However, we certainly understand for investors that this is a concern. And so if we're able to address those concerns by finding and securing some supplemental insurance, we're happy to do it.
Got it. So, and what are some other risks, if you can, identify those for us or define them? When someone is trying to invest in farmland?
I think there's always going to be an operator risk. We mitigate that by working with some of the finest institutional grade operators in the US. So our operating partners have been farming in these areas for 40, 50 years, sometimes more. So they know these lands better than anyone. And we have the utmost confidence in them. But they are human like us all. And so there's always a potential for operator error and either poor yield or some other impact because of the operator. I would say another risk, we are operating in a market. And so if there is an event that causes price to suddenly move up or down, obviously up is typically a good thing for our investors, but risk is uncertainty. So up or down, it could change, the underlying, it could cause the property to deviate from our underlying projections of what the distributions would look like. And so that introduces some uncertainty to our investors, which of course we want to mediate as much as possible. And so we wish we had a crystal ball, but we don't. So anytime you're dealing with financial markets, the price volatility is of course a risk.
Right.
So those are a couple.
Got it. So, and how has, because I can tell you have been following financial markets, and of course I do too, because that's what we are doing here, right? So how has COVID-19 impacted financial markets?
Oh boy, that's a PhD dissertation. I think based on conversations I've had with many of our clients and many of the thought leaders in the space, I think what has been most interesting on how, I'd say two things. One, coronavirus has very much put into focus and into front and center stage for downstream consumer-facing companies who offer consumer goods, how important it is to have traceability and control of their supply chain. We saw so many CPG companies have their supply chains disrupted by a number of impacts, but be it closed ports, closed transportation, airlines, roads, borders, and it really disrupted their business and led to some pretty extreme mismatch in supply demand. And so what we're seeing in the food and agriculture space is some of those downstream CPG companies investing more heavily and looking at upstream partners, which is exciting for us as we've always thought it is important for the ag value chain to be more integrated. So that's one trend in our industry that we're seeing emerge. I would say the other trend that's more broad and less specific to agriculture is that many of our clients and investors no longer trust the broader equity markets to serve as a barometer of economic health.
Right.
We've seen the stock market react in almost, hypocritical ways with news that was coming out. When we look at unemployment and we look at labor and we look at productivity and output and we look at consumption and spend data, the math is just not
it's just the
what we're
stock
seeing.
market just bounced back like a spring and it's just going higher. I just don't understand. Same as housing market too. It's just there is no correlation anymore.
Housing, at least to me, makes a little bit more sense because housing has a little bit more rationales. You can break it down into areas and there's supply and demand. And again, it comes down to real asset, and having fundamentals. But the stock market, that's the problem with intangible assets. You're investing into, a company or a software or an idea. Because you don't have a hard asset to anchor you down, those expectations can fluctuate wildly, and that's the problem that we see in our investors share, of why they're so, I don't even think disappointed is the word. I think just untrustworthy. They do no longer trust, what they're seeing in the broader indices, be it the Dow Jones, the NASDAQ, the S&P 500, the Russell, doesn't matter. And so for us, it's actually been a benefit, I think, for all alternative managers. It is a benefit because now is a chance to sort of highlight the benefit of alternatives, which is, again, diversification and offering investors access to an uncorrelated asset class.
Got it. No, that's great. What makes farmland a stable investment during and post COVID-19?
I would say, again, what makes farmland stable during COVID-19 is the fact that people still need to eat. This is a durable good. Fundamentals do not change meaningfully. I don't want to say they don't change at all, but they do not change meaningfully. It's very different than other commodities or other goods. And so, in our view, I don't want to say there's been no impact. There has. If you look at almonds, actually, there was tremendous impact back in the spring because almonds are US almonds are typically often sold to Asia, specifically China.
Right.
And many of the Asian ports had closed because of coronavirus. And of course, Asia went through their first bout of, China particularly went through their first bout of coronavirus ahead of the United States. And so you saw that impact hit earlier, you saw the ports closed, and we had no place to ship our almonds, and they sort of backfilled, and that led to price decreasing meaningfully. I think almond prices declined by 30%, 35%. But eventually the ports began to reopen, the almonds were shipped, and we saw some price recovery. Now, are prices where they were last year? No. But we are seeing recovery, and we believe that prices will eventually return back to where they were. So that's the, I call it's rational volatility in my mind. There's a reason why price it moves. And as long as you can justify the fundamentals and you can make sense of supply and demand, you'll have a good idea of, what the market should do and how your investment will do, because this is a durable good, and we're not really dealing with preferential demand where it's finicky. It's rather stable here. Now, after COVID, I think actually there's going to be increased demand and increased reliance on the ag sector. I think consumers have realized how important it is to have direct access to healthy food.
Oh, yes.
I think there's other trends that are emerging that have been emerging well before COVID, such as alternative proteins, plant protein.
Yeah.
Now
exactly. You're talking my language. As I said, I'm vegan. I take plant protein every day.
Yeah.
A lot of avocados.
Absolutely, healthy fats, healthy grains. So we're we don't see that trend going anywhere. We think that's a long-term trend that's going to continue to build. We're going to continue to see new technology to support that sort of production. And so in our view, I think post-COVID for farmland and ag looks actually even brighter. I think COVID ended up looking pretty bright. I think the asset class has performed well under this incredibly uncertain time. If you look at the US Farmland Index performance, when basically every other index in Q1 fell precipitously, if you look at the stock market, if you look across financial markets, Q1 2020 was a terrible quarter. I think farmland decreased, I can't even remember the figure, maybe 0.5%, if that, basically a blip. And then in Q2, there was a positive return, a recovery that more than offset the Q1 loss. So we're in positive territory now for farmland for 2020. And that's the hardiness of the asset class that, I just love so much. I argue it is the best asset class for capital preservation.
So what is your background and how did you get involved in farmland?
Sure. So my background, believe it or not, well, first, this is a little odd and it's not meant to be this poetic, but I did grow up around farmland. So I grew up in upstate New York. My first job was on an apple orchard when I was very young. I wish I could say I knew from that day I was going to work in ag. I didn't. I always loved weather and climate. So growing up in upstate New York, I got to see everything: blizzards, tornadoes, hurricanes, you name it, we had it. And so I studied atmospheric science in college and climate change. And rather than pursue a career in academia or research, I wanted to go into industry. And so when looking at industries, I asked the question, which industry will be most impacted by climate, but also could positively impact climate? Can industry help us solve this issue? And my view and my conclusion was that ag is the industry for that, where there's a circular relationship here in ag, and more specifically farmland, where obviously the way the climate changes will impact where we can grow what. In some areas it will be harmful, in some areas it will be helpful. Additionally, the way we manage our farmland, our management practices, how we, if we rotate crops, whether or not we till the soil, whether or not we introduce biodiversity, these management practices can either sequester carbon from the atmosphere and help us mitigate greenhouse gas emissions, or we could deplete soil nutrients, deplete topsoil, and put ourselves on course for a much larger problem in the short term and medium term. So for those reasons, I just thought this is an interesting problem. And then of course I realized, it's not a sexy industry. Not that many people are looking at it. It's kind of been forgotten by technology. It's kind of been forgotten by investors. And to me, that made me think this is going to be a really exciting place in the next 50, 60 years to be. So that's how I ended up here.
That's awesome. Let's take a quick break, David. And after the break, we'll go through my usual questions, which I ask every guest.
Okay.
Welcome back to Wealth Matters Podcast. I am chatting with David Chen about FarmTogether and agriculture business. David, are you ready for fire round?
Oh, yeah.
Okay, let's go. Would you be changing any business or investment strategy after coronavirus?
Broadly speaking, no. I think our strategy is the same as what it was before.
Got it. Favorite real estate or finance or any other related book?
I would have to go with, Nature's Fortune by Mark Turchak and Jonathan Adams.
I have not read that one.
It's a good one. It sort of highlights the need to underwrite for environmental externalities when you're investing. So definitely recommend that one.
Nature's Fortune. Okay, I got to put it in my list. Any tool or website you recommend or you cannot live without?
Oh, man. I would say, is it fine if it's not exactly for like work use?
Oh, yeah. Anything. Yes.
Awesome. I was so sad when all the gyms had to close earlier this year. And I was so afraid I was going to get out of my routine. And I found an app. I should look up exactly what it's called here. Let me see. It's called WOD Timer, WOD Timer.
Yes. Yeah. So you are into CrossFit. I used to do CrossFit.
Yeah. That app has saved my life this year.
Oh, okay. I got to look into it. Yeah, I ended up building a gym in my garage because I'm like you.
Nice.
I was very sad. I'm like, okay, I go every day at 5:30 a.m. How can I sustain? That was the my time, right?
Yep.
So no, I'm gonna look it up. Any advice for beginner investors?
I would say just read as much as you can, get in front of as much content as you can, listen to as many podcasts, as many speakers as you can. I think in some ways it's always good to view yourself as a beginner investor for as long as you can. I still think of myself as a beginner investor and I'm a professional investor, but it's because we always have something to learn. And so I would encourage anyone to just continue reading and continue learning.
That's a great advice because, and you are a professional investor, but of course you continue to learn, right? That's the whole process, right? In any industry, in any environment, you got to be open to, learn, right?
Yeah.
No, that's awesome. How do you give back?
The way I give back, so I've had a couple of organizations that have been super meaningful to me and helpful to me in my path. And so one of them is the Hispanic Scholarship Fund. And so I am on the New York board of that organization, and I help them continue to be the largest provider of scholarships to the Hispanic community in the United States. I also am involved with the Twigo Foundation, another wonderful nonprofit organization that is looking to increase the number of underrepresented minorities working in finance and investing. And then I'm very involved in all of my alumni communities. And so sometimes I serve as a volunteer admissions contact, or will help candidates as they're applying with their admissions essays or preparing for the interviews. And it's also a nice way for me to continue to feel connected to my alma maters. As I'm still fairly recently removed, but as the years continue, I start to see how easy it is to kind of fall away from that. So it's my way of trying to stay connected.
That's great. How can my listeners reach out to you?
So they can visit us at www.farmtogether.com. And then if they have any questions about FarmTogether, farmland investing, they're more than welcome to reach out to me directly via email, and I can be reached at david@farmtogether.com.
Awesome. Thank you so much, my friend.
Thank you. It's been great being here.
Yeah, take care. So this was a great episode. I'll be very appreciative of you if you can go to YouTube and subscribe and share my channel, or if you can go to Apple Podcasts and leave a 5-star rating. If you leave a 5-star rating, do email me and I can send you a free copy of my Amazon #1 best-selling book, Resilience: How to Turn Your Setback into a Comeback. Till then, next time, see you later.